The artificial intelligence craze finally cooled off this week, just in time for the rest of the stock market to rally, although we're still led by big tech. So let's take a look at the moves I made in my portfolios and where I plan to go from here. SoFi Technologies was the big winner in my investments in play portfolio this week on the back of the debt ceiling bill, which included provisions to stop the moratorium on student loan payments. Since SoFi's main product from its beginning was loan consolidation, the last few years since the pandemic started have been particularly hard, as they've received no payments on any of the student loans that they hold. As a result of the debt ceiling agreement, SoFi ended up popping 29.76% this week, easily landing in as the week's biggest winner in the portfolio. Canopy Growth Corporation is once again the biggest loser in the portfolio this week for 2 weeks in a row. Despite the debt ceiling agreement helping the rest of the market rally, there was nothing in it to help cannabis stocks. They are still under pressure with no legislation on the horizon to help legalize cannabis on a federal level. As a result, Canopy Growth fell another 5.95%, earning itself the spot of the portfolio's biggest loser. Ride-sharing company Lyft got a lift this week. I'm sorry I had to do that, but analysts are saying that Lyft is now one of the stocks you should hold in your portfolio, so it saw a significant pop on the back of this analyst coverage. Lyft jumped 14.32% this week alone, which made it the week's biggest winner. And from here, it looks like it's got some momentum and may actually challenge its recent $11 high before its earnings report recently. Even though gold in the precious metal sector didn't have a great week this week, that wasn't responsible for Golden Minerals, my ultra-speculative penny stock, for selling off 34.92% and being the week's biggest loser. The real reason behind the sell-off was that Golden Minerals approved a reverse stock split on Tuesday. For every 25 shares a shareholder holds, they'll get 1 share. And next Friday, June 9th, the stock will be multiplied by 25x. This doesn't add or detract value. So what exactly happened and what made it sell off? When you're talking about a penny stock, they become trading vehicles. People are trading them because they can buy huge quantities with a small amount of money and manage the trade carefully. When you make it so that you only have 1/25 of the shares that you had before, a lot of those traders will flee like rats from a ship, getting out of the penny stock before it reverses and becomes a $2.50 stock. As a result, Golden Minerals was this week's biggest loser, getting smacked hard as traders escaped its 25x reverse split. Apple is one of my biggest positions. However, whenever it outgrows the portfolio target allocation of 7.14%, I need to take profits. I have to have that investing discipline. Even though I think Apple could go much higher from here, I took profits at $178.04. which locked in 31.16% in gains on shares that I bought for $135.74 back on February 10th of 2021. This sale lowered my per share cost by $7.96, from negative $60.64 to negative $68.60. A negative per share cost means that I've taken all of my original capital out of this position, in addition to profits of $68.60 per share of all the shares I still hold in Apple. Even after this sale, Apple is still a full allocation size in my portfolio. So if it continues higher, I'm going to have to take more profits, with me targeting $199.36 as my next sell target, slightly under the psychological level of $200 even. I will add the shares that I sold back into the position if Apple sells off, and I'm looking at a level of support above its 2022 lows, with my next buy target at $129.60. I added to my super speculative junior gold miner, my penny stock Golden Minerals, this week twice, once at 16.19 cents on the 30th, and again at 13.37 cents on the 31st, giving me an average buying price of 13.61 cents. The combined buys lowered my per share cost 6.75%, down from 28 cents even to 26.11 cents. And I have no intention of adding anything else to this position until we see the price action following next week's reverse stock split, which will take place on Friday. and it's a 1 for 25 split, so it will be significant. My next sell target is 27.99 cents, but of course, that will change too after next week's stock split. So for right now, Golden Minerals is a hands-off as we wait to see what the price action will do in the coming weeks. In what seems to be a weekly occurrence, I took profits in Nvidia once more this week with a sale that went through at $413.53. I have to keep taking profits in Nvidia because it's outgrowing my portfolio allocation target by such a large margin. It's just my discipline. No matter how much conviction I have in AI or Nvidia for the long term, I have to peel off profits here. The sale locked in 2,538.36% in gains on shares that I bought when I opened the position on September 6th of 2016 at $15.67. Even after this sale, Nvidia is still the largest position in my portfolio and is still larger than the 7.14% target allocation for the portfolio, ringing in at 7.84%. Accordingly, if Nvidia continues to rally, I'll continue to take profits, with my next sell target at $449.97. Additionally, I'll add some shares back into Nvidia if it sells off, with my next sell target being a point of support at $264.12. And even though that's more than 35% lower than here, you have to remember, Nvidia has regularly sold off 35 to 50% many times in the past. And if it never happens, that's fine. It's still the biggest position in my portfolio right now. I added to my short position on the Nasdaq 100 using the inverse ETF QID this week with a buy at $14.60. This buy lowered my per share cost 1.64%, down from $18.30 to $18 even. And if stocks continue to rally, I'll continue adding to this short position with my next buy target at $13.55, a price I calculated using the Fibonacci method. Additionally, if we start to see a sell-off, I'll start reducing the position size pretty quick, with my first sale at $18.70, just under a point of resistance QID's seen in the past. I added to my short position on the S&P 500 with the SPXU twice this week, with my first buy being at $12.55. And when the S&P 500 rallied into the weekend, I made a second buy at $11.95. These combined buys lowered my per share cost 2.58%, down from $13.55 to $13.20. And if stocks continue to rally, I'll continue adding to this short position, with my next buy target at $11.10, a price calculated using the Fibonacci method. I'll also start peeling off profits if the market starts to sell off in June, with my first sell target at $13.75, just under a point of resistance that the SPXU has seen many times in the past. I took profits in my Salesforce position this week right before it reported earnings, with a sale at $220.95. Salesforce has a tendency to be extraordinarily volatile after it reports earnings, whether or not it goes to the bull side or the bear side. Accordingly, going into a binary event with such a dramatic outcome means that I have to be risk averse. And since Salesforce had seen a really significant rally going into earnings, I decided it was time to take some profits. The sale locked in 22.25% in gains on shares that I bought for $180.73 on April 21st of 2022. The sale lowered my per share cost 23.14%. Down from $114.75 per share to $88.20 per share. From here, my next buy target is slightly above Salesforce's low from 2022 at $127.20, because when Salesforce sells off, it has a tendency to do so in a dramatic way. Additionally, if Salesforce continues to rally, I will take more profits, but not until it reaches $275.10. A past point of resistance Salesforce has seen many times over the years. I took profits in SoFi Technologies when it popped after the debt ceiling agreement had been passed. Part of the debt ceiling agreement was the removal of the moratorium on student loans. And since SoFi's main product was student loan consolidation, they haven't been receiving any payments for the last 3 years on those student loans. As a result, SoFi rallied significantly this week, which led to me taking profits with a sale that went through on Thursday at $7.05. This sale locked in 64.72% in gains on shares that I bought for $4.28 back on December 28th of last year. The sale also lowered my per share cost 1.14%, down from $4.40 to $4.35. And if SoFi continues to rally, I'll continue to take profits, with my next sell target at $8.18, just below a high that it saw earlier in 2023. Additionally, I'll continue adding to my SoFi position if it sells off, but I have to wait for it to get below my cost basis, so I'm going to wait for it to get closer to $4. I think if we see an epic sell-off, it's possible that SoFi's low of $4.24 from the past won't hold. My next buy target is at $4.07, and if SoFi never goes that low, then that's fine. What I have is what I have. This has been a surprisingly successful position, especially since I just opened it on November 22nd of last year. If you want to follow along in all of the moves in all of my portfolios, you can do so 100% for free at my website, getirk.com. Please hit like and subscribe. It really does help the channel out, and I'll see you in the next video.